And I get this comment too. Well, hey, it's really not a lot of money. It won't accumulate much. Let me tell you something. So what I did here is I did some analysis. This is no specific product, by the way, but I just did some analysis, some what if you will. And if you put in $7,000 per year and you were age 55 and you put in for 10 years and you stopped and you made about, 6% per year on that account, well, you'd have about 100,000, if I have it right. Yeah, 10 years, you have about 100,000 after 10 years, but 20 years later, so a full 30 years, now 20 years later, you're now 85. And if you looked at my chart earlier, the chances of you still being around are pretty good. You would have almost a $300,000 account here by putting in $7,000 for 10 years and stopping, and then you just let that account bake for perhaps long-term care help at age 84, 85. So, please don't dismiss the compounding nature of this and how helpful this could be later in life. It can amount up to some good dollars saved. So take full advantage of employer-sponsored retirement plans. Many times these plans will match. I often will recommend that folks put in at least enough money to get the free match. There's nothing like free money. So just to give you an idea, comparatively speaking, we've been talking about the traditional IRA and the Roth IRA with either the $6,000 or $7,000 limit. Your employer plan is very different with how much you can put in. So in 2022, the salary deferral for the 401k and similar plans, it's $20,500. And then it's $26,000 if you're over 50 years old. So that's basically a $6,500 catch up that they allow you to do in employer plans. So if you have the ability to participate in an employer plan, I would do so. Because that you can't beat that free money. Okay, so put in enough for the free money, and if you want to put in more than that, and you have the income eligibility to do so, you may consider putting dollars in a Roth. Okay, 6 rollover options. This is something I educate folks on all the time to make sure that they are clear on what they're able to do. If you leave an employer and go to a new job, you can leave your 401k plan exactly where it is. Many folks do that, for whatever reason. Many folks do that and don't, move it over. And when I say that, so number one, the first choice is you can leave it where it is. You can, number two, you can move it over to the new employer, and you can contribute your old 401k and add it into your existing 401k with your new employer. The only caveat there is that the custodian needs to allow that. So the custodian that runs the money, that manages the 401k for your new company, they have to allow that. I haven't seen a case where it hasn't allowed it, but I just need to give you that caveat. So number one, number two, number three, you can roll over your plan assets to an IRA. Now, I will tell you that numbers 1, 2, and 3, none of those are a taxable event. You will not experience any taxation on 1, 2, and 3. Many folks do roll over their assets to another plan, to an IRA, because they may have choices in the IRA that they don't have in their existing program. So that's very common. People do that, and that's one of your 6 choices. Okay, moving over to the right column, number 4, you can take a lump sum distribution of your plan balance. I don't necessarily recommend that one. That is a huge taxable event. You will owe income taxes on all the dollars that you take out on that one. Number 5, you can take your plan and you can move it to a Roth IRA. I think that's a step above number 4, but number 5 is a taxable event as well, but at least you have the dollars sitting in a Roth IRA, which now is growing tax deferred, and the dollars will come out tax free. And then the 6th one, you can make an in-plan Roth conversion of your plan assets. So if your plan allows, you can take the 401k and move it into a Roth 401k, and that would be a taxable event to you to do so. So the left column, numbers 1, 2, and 3 are non-taxable events. The right column, 4, 5, and 6, those are all taxable events if you were to choose them. But everyone should know that you have these 6 options whenever you have a 401k or a 403b, any employer plan that you've left, you have those options. All right, so taxation. So this is basically your non-Roth. This is how the federal income tax brackets look. Incidentally, they're very wide. So if you look here at the 22% bracket for married filing jointly, if you make jointly between 83,551 and 178,000, you're in the 22% bracket. That's a very wide bracket, much wider than what they were back in 2018. So it's really, and this basically is very conducive too, by the way. Let's just say your joint income is $100,000 and you wish to do Roth conversions. Well, you could convert up to about $75,000 of an IRA and pay the tax. Okay, I understand, pay the tax, but you would not leave the 22% bracket on the taxation of that $75,000. If you think taxes are going to be higher in the future, well, that might be a very legitimate strategy for you to go ahead and do that Roth conversion because you will never pay tax on that money again. So just give you an idea that, you know, these are very generous limits, brackets, I should say. They're very wide. They really are before you get to the next marginal tax percentage. And just by way of history, our tax structure, so the highest marginal tax rate, is right here. So it's over 90%, and that was back in the 1940s, okay, 1943 to be exact. That was the highest marginal tax bracket. So as you look at this kind of bumpy chart here, and we're all the way out here, you can see that we are in a relatively low tax bracket history for the country. And the reason I bring this up is because what I like to say is taxes are on sale. So again, if you were considering doing Roth conversions from a planning perspective, this might be, a very opportune time to seriously consider that along with your tax professional on whether that made sense. But this is pretty interesting in that it's a very low top income tax rates right now. The potential side effect of IRA distribution. So everything is not nirvana. So if you basically pull money from your IRAs, that's additional income. That additional income, it may increase your exposure to the 3.8% surcharge on net investment income. You may experience some phase outs of deductions and tax credits that you otherwise could receive, but now that additional income has pushed you over those limitations. You may experience an increase in Medicare Part B premiums. That's called the IRMA, the Income Related Monthly Adjustment. And incidentally, it's not just Part B, it's also Part D. Part D is also, the IRMA is also applicable. So that's Part D, and that's D as in David, or drugs, okay? It may increase the amount of taxable Social Security benefits. So just be aware of that. Reduce or eliminate financial aid. So your FAFSA, your expected family contribution, may be affected for your child's education because, for example, if you elect to do a Roth conversion, that is pulling money out of the IRA, that is adding to your taxable income. It may indeed put you over a threshold where you would otherwise receive some financial aid. So just be aware of that. Reduce or eliminate Roth IRA eligibility, eligibility, and more. So just you need to be aware of that. Required minimum distributions. Okay. Avoiding IRA withdrawals. Well, it allows the account to grow tax deferred for as long as possible. But remember something, that's not all of your income. Okay. That's not all of your money. You have to pay tax on that money. So the higher the balance grows, when you get to the required minimum distributions, the more you're going to have to take out. It also keeps income off your tax return. But as I mentioned there in blue, you can't avoid taking money out of your qualified or IRA accounts forever. You are going to have to take money out down the road. So required minimum distributions, so more about those. So they begin for IRAs at age 72. Again, that is new. The Secure Act changed it from 70.5 to 72. And just historically, back in 2020, RMDs were actually eliminated for that year in 2020 due to the COVID situation. Required minimum distributions begin for most plans at age 72. So the first line deals with IRAs, the second line deals with plans. So if you have a 401k, 403b, 457, normally you must start taking distributions from those plans at age 72. Incidentally, you don't have a choice. Well, to be exact, you do have a choice. You could not do it, but then please look at my blue statement there. Failure to take an RMD can result in a 50% penalty. It is in your best interest to take the RMD. You do not want to pay a 50% penalty. And it really is they're quite strict about it. So for example, if you had to take a $20,000 RMD and you failed to do so, not only do you have to take the $20,000 that you didn't take, but you'll be assessed a $10,000 penalty for not doing this when you were supposed to do it. So they're very strict on it, and I would coach people to be very athletic around focusing on this and make sure that you do it properly. Incidentally, I've been asked, excuse me, this question before. Is, well, I have my account with a custodian. I have it with Charles Schwab. I have it with Fidelity. They'll just tell me what I have to take. Just remember something, that could be true, but ultimately the IRS looks for the taxpayer to take on the responsibility and make sure that the amount that you're taking out is proper and correct. So even though that might be the case, they might tell you the number, ultimately it's the taxpayer's responsibility to get the number right. So just be aware of that. Okay. All right. So how do you calculate the RMD? Well, it's actually pretty simple. But it does change each year. It is not, it's the same formula, just the percentages that are used and the balance used is different. So you obtain the prior year-end balance. So let's just say you turned 72 this year. Well, what you would do is you would take all of your qualified accounts, IRAs and 401ks that are out there, and you would basically multiply that 12/31/21 balance by a factor. And you see here, I'll just go to quickly to the next page. The factor is 3.65%. So if you have 100,000, just to make the math easy, if you have a $100,000 IRA and you have to take out 3.65%, you'd be obligated this year to take out $3,650 before December 31st to satisfy your RMD. That $3,650 would be included in your taxable income for the year. Next year, you will have to do it again. So once you hit 72, you have to do this exercise every year. But next year, in 2023, the formula is the same. It's just that you would use the year-end balance of 12/31/22 to determine what you take next year. And because you're a year older, the 3.65% is no longer the valid factor. The valid factor now is 3.78%. So you see how it works. So at the end of each, multiply it by the RMD percentage, and that's what you'll have to take out. And that would be taxable income for you. That's how they do the RMD.